Our next guest has raised his S&P target amid the sell-off to one of the most bullish on the street. Now seeing 4,500 for the S&P by the end of the year. One of the main reasons, incredibly strong earnings, which we were just talking about. But if investors aren't buying those blowout earnings, what can push stocks higher? Let's bring in the man behind the prediction, Brian Belski, Chief Investment Strategist with BMO Capital. Brian, always good to see you. Why move higher now?
Well, Tyler, always great to dine with you at Power Lunch. Sure. I think we're moving into more of a fundamentally driven market. You know, last year was really about momentum and PE-driven markets. And we do think that analysts have their projections for second and third quarter numbers in particular that are too low. And lastly, why earnings are so good in the United States with respect to our companies, because we have the best companies in the world. And, oh, by the way, one of the most diversified markets. So I think this is going to continue. And I think from by and large, we are starting to see, obviously, in the fundamental data that things are broadening out. And performance-wise, I still think that investors are too short-term oriented and not really believing the strength of the bull market and really kind of feeding more on the rhetoric of inflation or Bitcoin or all this other stuff that I think is more of a sideshow. By and large, Tyler, we remain very bullish. We upped our number. Remember, we were one of the first people to put out our target for 2021 back in November at 4,200. And so we typically like to increase our targets when the markets are down. We don't want to chase the market like most of our competitors. So we have a process and a discipline, and we thought last week was a great time to raise the number.
Talk me through your analysis of the sell-off in technology, the idea that multiples have compressed in many technology sectors. I mean, there's technology and then there's technology, obviously. Talk me through that and tell me whether you think now is a good time to be buying more technology because it is sold off, or what?
It's a great question, and your network have done a wonderful job talking about the different parts of technology, and the sector is massively different than when it was in 99, 2000. And if we go back and think about WorldCom and JDS Uniphase and Selectron and all these companies that were poster children for the tech wreck. Remember, the technology sector was much less diversified, and it was all about a capacity-led recession that too much tech was flooded into the marketplace. If you take a look at what's happened recently, some of these high-flying stocks have clearly been humbled. Whether or not it's the Cathie Wood stocks or Tesla or not, you have to be humbled sometimes in life and in the markets, and that's exactly what's happening. And I think Dominic Chu really was helpful with respect to his comment on Apple and Microsoft. Really different there in terms of where earnings are. We think those companies in particular, in terms of the quality of earnings growth, the quality of cash flow, is really what's going to drive technology higher. So over the next 3 to 5 years, our favorite sectors in the U.S. market remain technology, communication services, and consumer discretionary, because that's where we see the longer-term secular growth. So yes, we would be buying these high-quality, large-cap, consumer staple-ish-like technology names on these pullbacks, but we would still stay away from these high-flying names that, quite frankly, probably still have some more humbling to go.
Shepard Smith here. Thanks for watching CNBC on YouTube.